and welcome everyone to example 13-2. As a quick reminder, you can download this Google Sheet in a description to the video below. You can pause the video, try the example yourself, and then come back and watch the solution. Let's go through it together. The background says the shareholders' equity section of ABC Inc.'s December 31st, 20XX balance sheet is presented below. So in the shareholders' equity section, we would expect to see contributed capital and retained earnings. Contributed capital is going to be divided further into the different types of shares that we have, and contributed surplus if there is any. In this example, we see that we have preferred shares and common shares only. The preferred shares have a $2 dividend rate and they are cumulative, meaning if the business does not pay a dividend in the year, that will accrue and would be owed to the preferred shareholder whenever dividends are paid. We can see, as of the end of 20XX, 3 years are already in arrears or have accrued. 20,000 shares were authorized and 10,000 shares were issued and outstanding for $175,000. The common shares are 10,000 issued and outstanding for $225,000. That would total and make our total contributed capital at $400,000. Retained earnings for this business is $120,000, resulting in total shareholders' equity of $520,000. We are asked to record the required journal entries, if any, for each item described below. Let's get to it. On January 1st, 20XY, the following year, declared $100,000 in dividends to shareholders of record on Jan 5th, to be paid on January 15th. That's a lot to take in there. January 1st is when the dividend is declared. That would be the declaration date. We do a journal entry on the declaration date to recognize the obligation. Who's going to get paid? Well, the shareholders at the end of business on Jan 5th. That is the date of record. That is an administrative or logistical date. There will not be a journal entry on that day because it's not actually a transaction. And when will they be paid? On January 15th. Paying out cash or distributing cash is a transaction, and there will be a journal entry on that day. Getting back to what we have to do for now, we have to record what's relevant for January 1st, and that would be the declaration of this dividend. Dividends are always declared from retained earnings, and they are a reduction to retained earnings. So we'll debit retained earnings, and we know the dividend is for a total of $100,000. There will be dividends payable, perhaps to each class of shareholder here. So payable, we'll set up a preferred payable just so we can keep track, and we'll do the same for the common shareholders. But of this $100,000, how much is going to get paid out to the preferred shareholders and how much to the common shareholders? We can calculate this. Going back to the narrative, there were a $2 dividend rate on the preferred shares, and we would multiply that by the number of shares that were issued and outstanding. That would be then multiplied further by the dividends in arrears. There were 3 years that accrued in a year in arrears, plus the current year, for a total, try that again, for a total of $80,000. The common shareholders would be entitled to the rest, or $20,000. The next item that we are asked to deal with is on January 5th, the date of record for the dividends declared on January 1st. Let's take a look at the required again. It asks us to record the required journal entries, if any, for each item described below. The date of record is an administrative or logistical date. A roster essentially is established to figure out who is going to get paid. In this case, since we are looking at January 5th, which is the date of record, there is no entry. It's not a transaction. It's a logistical or an administrative date. January 15th, the cash dividends are actually paid, the dividends that were declared on January 1st. So certainly this would require a journal entry. The way that's done is the dividends payable that were set up earlier are now settled. So we can debit dividends payable for $80,000, and we can debit dividends payable for the common shareholders for $20,000, and we credit cash for $100,000. Remember, in order to declare a dividend, there must be sufficient retained earnings to do so, and in order to pay the dividend, there has to be sufficient cash to do so. Moving along, the business reports net income of $32,000 for the month of January. I put in a couple of transactions like this just to remind us that now we've moved on to studying corporations. Income summary is closed to this new account called retained earnings. The next transaction on February 1st is we issued 2,000 preferred shares at $17.50 a share. It looks like this is being issued straight for cash. I don't see any mention of brokerage fees here, although typically a business would incur some sort of listing fee or brokerage fee to do this work. For the sake of simplicity, let's say none was incurred. We would debit cash for 2,000 shares multiplied by $17.50 a share. We would credit the preferred shares. It's important for the student here to appreciate the difference of the different numbers you need to keep track of. The number of shares in this question is 2,000. The dollar amount is 35,000. You need to keep track of both. I'll explain why in a minute. Finally, on February 28th, reported net income of $35,000 for the month of February. Again, I've included that just to get us used to the idea that income summary, instead of being closed to an owner's capital account or a partner's capital account, is now going to be closed to retained earnings. And that's it for what this example initially asked us for. But let's keep going. Let's make it a little bit harder. Let's add a requirement, shall we? Let's say requirement 2 requires us to prepare the shareholders' equity section of the balance sheet for the end of February, February 28th. What would that look like then? Well, we've already done this earlier. Maybe to save some time, I can copy this and talk about each element below. So the shareholders' equity section of a balance sheet should start off by saying shareholders' equity, and then beneath that we should be listing contributed capital. After that, contributed capital is made up of preferred shares, common shares, and contributed surplus. Contributed surplus is not relevant in this example, so we'll look at the preferred shares. I apologize, everyone. Luna is here with me, my great peer. She's a happy dog today, and she wants to say hi to you. Anyways, if we can ignore her for a second, preferred shares, $2 cumulative, 3 years in arrears. That's what was there before. 20,000 authorized and 10,000 issued and outstanding. So we know this has changed. 3 years are no longer in arrears. That can be removed. That amount has been settled, but they are still cumulative. The amount authorized wasn't changed, but the amount issued was changed. Instead of 10,000, 2,000 was issued. Added to 10,000, we now have 12,000 issued and outstanding. Let's take a look at the amount. We had $175,000, and we know more were issued. And we could add that if we go up here, $35,000 worth. So now we have 210,000 under preferred shares. Common shares, there was no change. No more common shares were issued and outstanding. Although retained earnings certainly did change. We started off with 120,000 in retained earnings. And then we should subtract an amount for the dividend. So if we scroll up, we know that when the dividend was declared at the very beginning, that was $100,000. So that should be subtracted. Then at the end of January, they had net income of $32,000, which should be added. And at the end of February, there was net income of $35,000, which should be added. So retained earnings is now at $87,000. That creates total shareholders' equity at the end of business on February the 28th of 20XY of $522,000. That's all for this video. Thanks for watching, and we'll see you next time.